Let's get one thing out of the way first. You've probably seen the headlines. Gold is at an all-time high. And your first thought? I missed it. It's too late to get in now, right? That feeling is completely normal. Honestly, everyone feels that way. When something is already up, we hesitate. We think the train has left the station. But what if that's the wrong way to look at it? What if the headlines are telling the wrong story? To understand that, we need to step back. We need to ask a different question, not, is it too late? But why is it doing this now? You see, gold isn't like a stock. It doesn't go up because of quarterly earnings. It moves for deeper, slower reasons that often get ignored. So let's ignore the price for a minute. Let's talk about what's really happening. Think about the world right now. What do you feel when you check the news? A bit of uncertainty, maybe. Some instability. That feeling has a tangible effect. It whispers to investors, and that whisper turns into action. But it's a quiet kind of action. It doesn't make the front page every day. It happens in the background, in the decisions of large funds, and in the quiet moves of central banks. Yes, those same central banks. They've been buying gold for years now. And not just a little bit. We're talking about hundreds of tons, year after year. Why would they do that? They have all the data, all the forecasts, yet they keep stacking it. That should make you curious. It tells you this isn't a short-term bet. This is a long-term repositioning. But what are they positioning against? That's the real question, isn't it? You might have an idea. Maybe it's inflation. That's part of it, sure. But it's only one piece. There's something else at play. A slower, more fundamental shift. And it changes everything about this story. That shift is happening in the global financial system itself. Think about the foundation of money for the last 50 years. It's been built on a specific trust in the US dollar as the ultimate reserve. But what happens when that trust is questioned? Not in a dramatic collapse, but in a slow erosion. Nations start to quietly look for alternatives. They look for something that isn't an IOU, something that isn't someone else's liability. That's where gold comes back into the picture. It's the oldest form of money that still works. It's no one's promise to pay. It just is. This isn't a conspiracy theory, it's just practical risk management. And you can see it in the data. Look at who's buying. It's not just the usual suspects. Countries you wouldn't expect are accumulating. They're diversifying away from pure dollar holdings. Does this mean the dollar is doomed? No, of course not. But it does mean the landscape is changing, and gold is benefiting from that change. Now, let's bring this back to the price. When you see a new high, what does it mean? In a normal stock, it might signal a peak. For gold, it can signal a breakout from a very long period of suppression. Honestly, the price has been artificially capped for years. How? Through complex paper markets where vast amounts of paper gold are traded. This paper gold often overshadows the physical metal. It creates a lower price discovery, but something is breaking that model. The demand for physical gold is starting to dictate terms. When people want the real thing, paper promises struggle. You can see the strain in the markets. Premiums for physical coins and bars have been high. That's a telltale sign. The paper price and the physical reality are diverging. And that brings us to a critical point. Is this rally built on speculation, or is it built on a tangible shortage of trust? The evidence points to the latter. The buying is too broad, too institutional. It lacks the frenzy of a speculative bubble. It feels more deliberate, more strategic. And that makes all the difference for an investor, because strategy has a longer timeline. It doesn't panic and sell overnight. It holds. So, is it too late? Let's reframe that question one more time. Is it too late to buy insurance after you smell smoke, or do you buy it because you see the risk? Gold, in many ways, is financial insurance. Its price isn't just about making a profit. It's about preserving what you already have. That's a key distinction most people miss. They see the rising price and think a quick gain, but the big players see it as permanent protection. This changes the calculation entirely, because if you're buying protection, timing is less critical. What matters is that you have it before you need it. And the need seems to be growing, doesn't it? Look at the debt levels across major economies. They're not going down, they're accelerating. How does that story end? No one really knows. But uncertainty itself has a value. Gold is the asset you hold when you don't know the ending. Now let's talk about the fear of buying at the top. It's a real fear. But history offers some perspective. Look at the last major bull market in gold. It ran from around 2001 to 2011. During that decade, there were so-called tops every year. Each new high felt like the peak. But the trend continued for a long, long time, because the underlying reasons kept strengthening. We might be in a similar phase now, a new bull market that is just getting started, one driven by those institutional and central bank flows. But what about the everyday investor? Should you just jump in? Not so fast. There's a right way and a wrong way to think about this. First, you have to understand what gold is not. It is not a get-rich-quick scheme. It will not pay you dividends. It will just sit there. And that's the whole point. Its value is in its stability when nothing else is stable. So the first rule is to see it as a foundation piece, a small, solid part of a larger portfolio, maybe 5%, maybe 10, but not 50. That brings us to the practical question. If you decide to buy, how do you do it? Do you buy the physical metal or an ETF or mining stocks? Each has very different risks, and that choice matters more than the timing. Let's break down those choices, starting with the simplest, physical gold. You can hold it in your hand. That's its greatest strength and its greatest hassle. It's completely outside the banking system. No one can freeze that asset, but you also have to store it securely, and you'll pay a premium over the spot price to buy it. Then there are ETFs, like GLD. They're easy. You buy a share in your brokerage account, but ask yourself, what do you actually own? You own a paper claim on gold held in a vault, usually in London or New York. It's convenient, but it's still a counterparty risk. Is the gold really all there? It probably is. But in a true crisis, that's a question you don't want to ask. Mining stocks are a different beast entirely. They're not really gold. They're companies that dig gold out of the ground. That means they're tied to the stock market. They're affected by management decisions, labor costs, and politics. They can amplify gains when gold rises, but they can also crash much harder when gold falls. So which one is right for you? It depends entirely on your goal. Is your goal pure, simple insurance? Then physical gold in a safe place has a strong argument. Is your goal easier exposure with liquidity? Then a reputable ETF might work. Are you trying to leverage a rise in the gold price? Then miners are your play, with all their added volatility. But here's the thing. The how is less important than the why. And your why should be clear by now. It's not speculation. It's a deliberate hedge. A hedge against a system that feels increasingly fragile. You know that feeling. Everyone does now. It's the background noise of our time. And that noise is what's moving this market. So let's address the elephant in the room. What could stop this rally? What would make gold go down? Strong, credible confidence would do it. If central banks truly tamed inflation, if global tensions visibly eased, if governments showed a clear path to sustainable debt, if all those things happened, gold's urgency would fade. But do you see that happening? Look at the political landscape. Look at the direction of travel. It seems like we're moving toward more friction, not less. Toward more debt, not less. That's the environment gold thrives in. And it's why this isn't just a passing spike. This is a reevaluation. A quiet, global reevaluation of what real money is. That process takes years, maybe decades. We are likely in the early stages. That doesn't mean it goes up in a straight line. There will be sharp pullbacks. Moments where it feels like the rally is over. Those are the moments that test your conviction. Will you see them as a warning or as an opportunity? The answer depends on your time frame and on how deeply you believe the story has changed. Let's talk about those pullbacks. Because they will happen. The price won't go up every single day. In fact, a healthy market needs to correct. It shakes out the weak hands, the short-term speculators who got in for the wrong reasons. When they sell in a panic, that creates a better entry point for someone with a longer view. So a drop isn't necessarily a bad thing. It's a feature of the market. The key is to not be the one panicking. To do that, you need a plan before you buy. Decide what percentage of your portfolio is for gold, and then stick to it. Maybe you buy a small amount each month, no matter the price. That's called dollar cost averaging. It removes the emotion from the equation. You're not trying to catch the bottom. You're just building your position slowly, steadily. This is how the big players operate. They don't bet it all on one day. They accumulate over time. You can do the same. But this requires patience. And patience is in short supply these days. We're used to instant results. Gold doesn't work that way. It's a slow, silent asset. For years, it might do nothing. Then, it might move dramatically. Its job is not to entertain you. Its job is to be there when other things aren't. Now, there's another angle to consider. What if you're still not convinced? What if you think this is all just hype? That's a perfectly valid position. You should be skeptical. So let's look at the potential downsides, honestly. The biggest risk is opportunity cost. Money tied up in gold isn't in stocks or bonds. If those markets soar while gold sits still, you miss out. Gold also doesn't produce anything. A company can innovate and grow. A bond pays interest. Gold just is. It's a sterile asset. For it to work, other things have to go wrong. That's a bleak bet to make on the future. Is that a bet you want to make? It's a personal question. There's no right answer, only what's right for your peace of mind. And that's the core of this whole discussion. Peace of mind. Can you put a price on that? Many people are deciding they can, and they're pricing it in ounces. Look at the retail demand in countries like China and India. It's not slowing down. It's accelerating. That's cultural wisdom playing out over generations. They've seen currencies come and go. They know what holds value through chaos. That steady global demand creates a price floor. It makes a catastrophic crash in gold less likely. The market is broader and deeper than ever before. So we're left with two narratives. One says this is a bubble, inflated by fear. The other says this is a rational response to real risks. Which story feels more true to you? Don't answer yet. Because there's one final piece of data that's hard to ignore. And it's not about charts or economics, it's about human behavior itself. That piece of data is simple. In times of real stress, people don't run to Bitcoin first. They don't rush into the stock market. Historically, they reach for gold. It's an ancient instinct. You can see it play out in border towns during crises. You can see it in villages when inflation spirals. The first thing they want is something physical, something universal. That instinct hasn't changed. It's just been dormant for the developed world because we've lived in a period of extraordinary stability. But what if that period is ending? The signs are everywhere if you choose to look. Not as doom, but as simple observation. Currencies are being weaponized through sanctions. That makes every country think twice. It makes them ask, are we next? And they prepare accordingly. This isn't theory anymore, it's happening in real time. So the demand isn't just from investors seeking yield, it's from nations seeking sovereignty. That's a powerful new driver. It's not going away because of an interest rate decision. It's a multi-decade strategic shift. Now, let's bring this back to you. The viewer sitting there wondering what to do. You're not a central bank. You're not a hedge fund. Your considerations are different. You need liquidity. You need simplicity. You need sleep at night. So here's a straightforward way to think about it. Allocate a portion. You're comfortable never touching. Treat it like a foundational rock in your garden. You don't dig it up every season to check on it. You just know it's there, holding the soil in place. That's the mindset. Without that mindset, you'll likely fail. You'll check the price daily. You'll get nervous and sell at the worst time. The metal will win, but you won't. So the real question isn't, is it too late to buy? The real question is, are you ready to hold? Are you ready to ignore the noise for years? If the answer is no, then maybe it's not for you, and that's perfectly okay. There's no shame in that. Gold isn't for everyone. It's for those who see the cracks in the facade and want a piece of something that exists outside of it. But let's say you are ready. You've decided to make a small permanent allocation. What happens next? You just live your life. You let the world unfold, and you watch. You'll see more headlines about all-time highs. You'll see analysts call it a bubble. You'll see it pull back 10%, and everyone will say it's over. Through all that, your position stays the same. It's just there, silent, unchanging. That's the strange power of it. In a world of constant digital noise, it's a quiet anchor. And sometimes, quiet is the most valuable thing you can own. Now, let's address a practical reality. You might be thinking, but I don't have much to invest. That doesn't matter. You can start with a single gram or a small fractional share of an ETF. The amount isn't the point. The active allocation is. It's about making the conscious decision, putting a tangible value on your own financial security. That shift in thinking is more important than the dollar amount. It moves you from being a passive observer to being an active manager of your own future. And that's a powerful step. But let's be clear about what gold won't do. It won't solve all your financial problems. It won't pay your rent. It's not a substitute for income or savings or smart investments. It's one tool in a larger toolbox. A very specific tool for a very specific job. The job of preserving purchasing power. Over the long term. We're talking decades here, not quarters. So if your investment horizon is less than 5 years, gold is probably not the right asset for you. The volatility might hurt you at the wrong time. You need that long runway for its qualities to really shine. Now, I want you to consider something else. A world where gold continues this climb. What does that world look like? It's not necessarily a doomsday scenario. It could simply be a world of persistent, nagging inflation, where money slowly loses its meaning, where earning a return is a constant struggle. In that world, holding gold is a form of sanity. It's a way to opt out of the erosion, just a little bit. But it could also be a world of more dramatic shifts, a fracturing of the global trade system, more regional blocks using different currencies. In that fractured world, a universal asset has immense value. Again, gold's role is as a bridge, a neutral ground that everyone still accepts. That's its hidden superpower. It's geopolitical neutrality. No country controls it. No government can print it. That's why the rally feels different this time. It's not driven by a short-term crisis. It's driven by a long-term loss of faith in alternatives. And faith, once lost, is hard to restore. So we circle back to the start. Is it too late? Look at it this way. If the story has truly changed, then we are at the beginning. Beginnings are rarely too late. They are often misunderstood. And right now, the rise of gold is deeply misunderstood. It's seen as a fear trade, a relic. But what if it's actually a clarity trade? A move towards the only form of money that requires no promise. That's a profound thought. It means the rally isn't about panic. It's about people and nations thinking more clearly, seeing the system for what it is. and making a logical choice within it. That logic suggests this has much further to go. But again, I must stress this. No one knows for sure. The future is opaque. Anyone who tells you they know is lying. All you can do is weigh the evidence, listen to the actions of the largest players, and then make your own calm decision. A decision based on prudence, not greed, on insurance, not speculation. That's the only way to approach this market. Anything else is just gambling. Let's talk about the counter-argument one last time. The argument that this time is different. Skeptics say gold is an obsolete relic, that Bitcoin is the new digital gold. They have a point about technology, but they miss the point about psychology. During a true systemic stress event, where do institutions flee? They still flee to US Treasuries first, and then increasingly to physical gold. The pattern hasn't broken. The digital alternative is still too volatile, too new. It hasn't been tested across centuries. Gold has. That history is baked into its value. It's a history everyone on the planet understands. You can't code that into existence. Now, consider the supply side. How much new gold is there? Mining it is getting harder and more expensive. New discoveries are rare. Production has been flat for years, so we have rising demand from multiple angles, and a supply that can't quickly surge to meet it. Basic economics tells you what happens next. Price has to do the work. It has to rise high enough to choke off some demand. We may not be there yet. In fact, we probably aren't, because the demand isn't discretionary for these big buyers. It's strategic. They'll buy, even if the price goes higher. That creates a very resilient market. But you're not a nation state. You can be more flexible. So here is a simple, actionable idea. If you're curious but nervous, just watch. Not the price, but the drivers. Watch central bank buying reports. Watch real interest rates. When real rates are negative, gold tends to do well. Are they negative now? In many places, yes. That environment is like fertilizer for gold. Watch geopolitical tensions. Do they seem to be easing or accelerating? Make your own checklist. Let the facts guide you, not the fever of headlines. This approach does something important. It turns you from a reactive spectator into an observer. You start to see the connections. You understand why gold moved on a Tuesday. Not because of a magic formula, but because of a real event. That understanding is your best defense against fear and your best tool for opportunity. Now, I'll leave you with a final perspective, one that has nothing to do with finance. Think about the longest-lasting objects humans have ever made: pyramids, temples, and gold coins. Everything else rots, burns, or is forgotten. Gold endures. That's not a mystical statement. It's a chemical fact. It doesn't corrode. That physical permanence echoes its financial role. It's the one asset that represents permanence in an impermanent world. Our world feels increasingly impermanent, doesn't it? Policies shift. Alliances change. Currencies devalue. Against that backdrop, permanence becomes incredibly attractive. Maybe that's the simplest explanation for this rally. Not fear of collapse, but a deep human desire for something that lasts. Something you can pass down, untouched by digital decay or policy shifts. That desire is timeless, and it might just be waking up again. So, is it too late to answer that call? That's not for me to decide. It's for you to feel. Look at the evidence. Listen to the quiet actions of the largest players in the world. Then listen to your own instinct. Do you feel the need for an anchor? If you do, then you have your answer. And the price today is just a detail on a very long timeline. We've covered a lot of ground. From central banks to your own psychology, let's tie it all together with a straightforward summary. First, gold is rising for structural reasons, not speculative ones. The drivers are deep and likely persistent. Second, this isn't a trade for most people. It's a long-term allocation, a form of savings outside the traditional system. Third, the how matters. Physical metal for security, ETFs for convenience, miners for leverage. Choose based on your goal. Now, what if you do nothing? That's a valid choice too. But understand the consequence. You are making an active bet that the current system will remain stable, that inflation will be tamed, that global tensions will ease, that debt will not matter. It's a bet on everything working out smoothly. Many people make that bet by default, without even realizing it. Owning gold is simply taking out an insurance policy against that bet being wrong. It's hedging your optimism. That's a perfectly rational thing to do. So let's end with a direct answer to the question we started with. Is it too late to buy gold? If you are buying it as a speculative trade to sell next month, yes. You are probably too late. That ship has sailed. The easy, quick money has been made. But if you are buying it as a permanent foundational asset for your portfolio, no, it is not too late. You're not timing the market. You're installing a financial security system. You do not ask if it's too late to install an alarm after a crime spike in your neighborhood. You install it because the risk profile has changed. The same logic applies here. The global financial risk profile has changed. The response to that change is ongoing. You can choose to participate in that response or not. There's no guarantee of profit. only the guarantee that you owned something real, something that has survived every financial crisis in human history. That's the core takeaway. In a world of digital abstractions and complex derivatives, you own a tangible fact. That fact has value beyond its price. It has the value of certainty. And right now, certainty is in very short supply. Look around. How many things in your financial life feel certain? Not many, I'd guess. Gold offers one small piece of that. A piece you can hold in your hand. That's a powerful feeling. It can't be hacked. It can't be deleted. It can't be inflated away by a keystroke. That's the fundamental argument. Everything else is just noise. Price charts, analyst predictions, short-term volatility. It's all noise. The signal is the metal itself and the growing global recognition of what it represents. So make your decision based on the signal. Ignore the noise. If the signal makes sense to you, then act. Start small. Be consistent. And then forget about it. Let the world worry about daily prices. You have better things to do. Your anchor is set. That's the entire philosophy in a nutshell. It's not exciting. It's not glamorous. But it is profoundly steady. And sometimes steady is the most radical position of all. We're nearing the end of our discussion. But before we finish, let's clear up one last misconception. The idea that gold is just for the wealthy or for doomsayers. That's simply not true. Look at the data on who's buying small bars and coins. It's teachers, farmers, engineers, regular people from all walks of life. They're not preparing for the end of the world. They're preparing for a more uncertain future. There's a big difference. One is based on fear. The other is based on prudence. Prudence is a virtue, not a pathology. It's the voice that says, have a backup plan. Gold is that backup plan in physical form. Now consider your own life. Do you have a savings account? That's a backup plan for unexpected expenses. Do you have insurance on your car or home? That's a backup plan for accidents. Owning gold is the same principle, but for your wealth. It's insurance against systemic financial accidents. Seen that way, it's not strange at all. It's deeply logical. But the financial industry often complicates simple logic. It pushes products that generate fees. Gold is simple. It generates no fees if you hold it physically. It just sits. And that simplicity is a threat to a complex system. That might be why it's so often dismissed. They can't make money from your simple bullion in a safe. Think about that for a second. The most recommended assets are always the ones that pay commissions. Gold rarely does. That doesn't make it wrong. It just means you have to think for yourself. So think. Weigh what you've heard here. Better yet, weigh what you've seen in the world yourself. Do you feel more secure about the global economy than you did 10 years ago, or less? Your honest answer guides your next step. This isn't about convincing you. It's about presenting a clear choice, a choice between total reliance on a system and a small measured degree of independence from it. Independence isn't free. You pay for it with the opportunity cost of other investments. But the price of total reliance might be higher down the road. That's the trade-off. Only you can decide if it's worth it. I'll leave you with this final observation. For thousands of years, across every culture, gold was money. That changed only about 50 years ago. In the grand sweep of history, that's a brief experiment. We are still living inside that experiment. And now, some of the largest players in the world are starting to question it. They are quietly moving back to the oldest form of money we have. Not because they are old-fashioned, but because they are pragmatic. They see potential cracks in the experiment. You can ignore that, or you can take note. Taking note doesn't require a huge bet. It just requires a small, thoughtful adjustment. An adjustment for permanence in an age of the temporary. That's the real story here, not a price chart. The question is, do you want a piece of that permanence? If you do, it's waiting. It has always been waiting, and it's never too late to remember what lasts. You've heard the case for gold. Now let's pause and consider the absolute worst-case scenario. What if you buy some and the price crashes tomorrow? This is the fear that paralyzes people, so let's walk through it. First, if you followed the idea of a small, permanent allocation, a crash shouldn't ruin you. It's a manageable part of your whole portfolio. Second, a sharp drop would likely be driven by paper markets, by traders liquidating derivatives. That often creates a discount on the physical metal, a discount for the exact asset you wanted for the long term. In that light, a crash could be a gift, a chance to buy more of your insurance at a better price, but only if you have the cash and the courage, and only if your original thesis remains intact. That's the key. Has the fundamental story broken, or is this just panic in the paper markets? You need to decide. This is why your why must be solid. If your why is just following a trend, you'll sell at the bottom. If your why is based on those structural shifts we discussed, you might hold or even buy. It all comes back to your foundation. Now, let's talk about an alternative view for a moment. What if the best move is to do nothing different? What if you just focus on earning more, saving more, and investing in productive assets? That is an excellent path, probably the best path for most people. Gold doesn't replace that path. It simply runs alongside it. As a silent partner that doesn't correlate with stocks and bonds, its value isn't being different. When stocks fall, gold often doesn't. Sometimes it even rises. That non-correlation is its practical magic. It smooths out the ride. And a smoother ride helps you stay invested for the long term. It keeps you from making emotional sells during market crashes. That behavioral benefit is huge. Maybe that's gold's real worth. Not the dollars it gains, but the bad decisions it helps you avoid. Think about the last big market drop. Did you sell in a panic? Many did. Having an asset that holds its value, or even climbs in that moment, changes your psychology. It gives you ballast. You feel less desperate. That feeling is priceless. It lets you think clearly when everyone else is fearful. And clear thinking in a crisis is how fortunes are preserved. So perhaps we've been asking the wrong question all along. Not, will gold make me money? But, will gold make me smarter with my money? Will it give me the patience and clarity to stick to a wise plan? The evidence suggests it can. That alone might be worth the price of admission. But we're not done yet. There's one more layer to this, a layer that involves looking beyond the West. Look east, to places like China, India, and Turkey. For them, gold isn't a debate. It's a tradition woven into the fabric of life. It's given at weddings, saved for daughters, used as collateral in times of need. This isn't just sentiment, it's a highly developed form of practical finance. A finance that operates outside of banks. In these cultures, a gold bracelet isn't just jewelry. It's a secret bank account you can wear, one that no government can freeze. That cultural wisdom is now colliding with global finance. As these economies grow, their citizens are buying more gold than ever. Not because of a news headline, but because it's what they've always done. Now, scale that up by billions of people. You get a tidal wave of consistent cultural demand. Demand that doesn't care about the Federal Reserve's next meeting. This demand provides a constant underlying support for the price. It creates a floor that gets higher over time. Western analysts often miss this completely. They see gold through charts and algorithms. They don't see it through the eyes of a family in Mumbai or Shanghai, where it means security, dignity, and independence. That perspective is a powerful reminder. Gold's value isn't dictated solely in New York or London. It's affirmed in markets and homes around the world every single day. This global base makes it uniquely resilient. Now, let's connect this back to you. You might not have that cultural tradition. You can still learn from its principles. The principle of holding real wealth outside the system. The principle of having an asset that transcends borders. That's the practical takeaway. Gold is the original offshore account. Without the paperwork or the legal complexity, you can take it anywhere, and it will be recognized. Try that with a stock certificate or a bond. It won't work. This gives you optionality. A quiet, powerful form of optionality. In a world where borders are hardening, that matters. But let's stay grounded. This isn't about fleeing the country. It's about having choices. And choices are the essence of financial freedom. The freedom to not be trapped by a single system. The freedom to have a plan B that's physical and real. That freedom is what's really being bought and sold in the gold market. Not just metal, not just a hedge against inflation, but a tangible piece of optionality. Once you see that, the price movements look different. They're not just numbers on a screen. They're a measure of how much people value that optionality. And right now, the price tells you that value is rising. The question for you is simple. How much is your own optionality worth? Can you put a number on it? Maybe you can. Maybe that number is the price of a 1-ounce coin or a few small bars. It's a personal calculation, one only you can make. We're almost at the end of our story, but a good story needs a proper ending. Not a prediction, but a perspective. Let's end with perspective. Forget about gold for a minute. Think about the nature of value itself. What makes something valuable? Scarcity, sure, but also durability and universal acceptance. Gold scores a perfect 10 on all three. Now look at our modern world. We create value out of thin air. Digital currencies, NFTs, complex financial derivatives. Their value is based purely on collective belief. And belief can change in an instant. Gold's value is based on physical reality and millennia of consensus. That's a much slower, heavier kind of belief. It's harder to shake. In an age of digital ephemerality, physical permanence becomes more rare, and therefore more valuable. This isn't a financial theory. It's a law of nature. Rare and durable things hold value. We are simply rediscovering that law. The current price rise is that rediscovery in progress. It's not a bubble, it's a correction. A correction back to a more ancient understanding of money. Seen this way, buying gold isn't a bet against the future. It's a bet on timeless principles, principles that have worked for thousands of years. That's a very long track record. Longer than any stock, any currency, any government. That track record deserves respect. Even a small amount of respect in your portfolio. So what's the final actionable step? Don't rush. Sit with what you've heard. If it resonates, start a research session for yourself. not on price predictions, but on how to buy a single gram or a small coin from a reputable dealer. Learn the process. Feel the weight of it in your hand, even if just in your imagination. That simple act of focused research changes your relationship to it. You move from abstract thought to concrete possibility. That's where all real decisions begin, with a concrete step. Your first step might just be to bookmark a dealer's website, or to set a reminder to check the premium on a small bar next month. Small, calm, non-urgent steps. That's the antithesis of the fear-driven buy now message. And it's the right way to approach this, because if the story is true, you have time. If it's not true, you haven't rushed in. You've been prudent. Prudence wins in the long run, every time. We've covered the drivers, the risks, the methods, and the mindset. The rest is up to you. You now have the map. The decision to take the first step is yours alone. But remember, a map isn't a prediction of the weather. It just shows the terrain. The terrain right now shows a landscape of growing uncertainty, and a single ancient path through it made of gold. Whether you choose to walk that path a little is your call. Make the call with clarity, not emotion, with purpose, not panic. That's the only advice that ever matters. And with that, we've reached the end of our discussion. Thank you for listening. Before the final words, let's address a silent question. What if I wait and see? That's the most common path, after all. Waiting is a decision too. It's a decision to stay exactly where you are. And there's safety in that. But consider what you're waiting for. Are you waiting for a clear signal? For all the experts to agree? That day will never come. There will always be a chorus of voices on both sides. The signal is never in the noise of opinions. It's in the quiet actions of those with the most to lose. And they are acting. You've seen the data. So waiting has its own cost. The cost could be a higher entry price, or it could be missing the insurance altogether before a storm you didn't foresee. Only hindsight will tell. But you don't have hindsight. You only have now, and the evidence in front of you. Now let's strip everything down to one final simple thought. Financial planning is about preparing for unknowns. You prepare for a job loss with an emergency fund. You prepare for illness with health insurance. What do you prepare with for a monetary unknown? For a shift in the very system that holds your digits on a screen? History suggests an answer. It suggests a physical asset that has weathered every single monetary experiment. That asset is gold. It's not the only answer, but it is the oldest and most persistent one. Its resurgence today is a clue that savvy entities are preparing for a monetary unknown. You can ignore the clue, or you can acknowledge it. Acknowledging it doesn't require a life-changing allocation. It requires a thoughtful one. Maybe that's the true conclusion here. Not a yes or no on buying gold, but a yes to thoughtful, prudent preparation. A no to blind faith in a system that is showing undeniable strains. That shift in mindset is more valuable than any metal. It's the mindset of a steward, not a speculator. A steward looks ahead, assesses risks, and takes small, deliberate actions. That's the heart of this entire message. Be a steward of your own wealth. Look at gold through that lens, if at all. See it as one tool for stewardship in uncertain times. Then, make your choice from a place of calm stewardship, not from greed or fear. That's how you win, regardless of the price next week. You win by making a conscious, controlled decision. You take back a piece of control. And in today's world, control is the ultimate luxury. The luxury of knowing you have a plan. Even if you never need to use it, that knowledge lets you sleep at night. And sleep, honestly, might be the best return on investment you ever get. We are truly at the end now. The story of gold is ongoing. You are just deciding whether to have a small part in its next chapter, or to watch from the sidelines. Both are valid, but only one is proactive. The choice, as always, is yours. The final chapter isn't about gold, it's about you. You've listened to the facts and the stories, you've heard the arguments from both sides. Now, the narrative fades away, and you're left with a quiet moment of decision. It's in these quiet moments that real financial plans are born, not in the frenzy of a bull market. So let the noise settle. Ask yourself one more time, but more quietly now. Do the reasons for owning a tangible asset resonate with your view of the future? Not the future on the news, but the future you're quietly building for yourself and your family. If they do, then you have a direction. If they don't, then you have clarity. Both are victories. Clarity is the goal. The goal was never to convince you to buy gold. The goal was to provide enough information for you to find your own clarity. That mission is complete. Now, a last piece of practical reality. If you take the step, you will have doubts. The price will drop after you buy. That's almost a guarantee. When it happens, remember your why. Recall the structural drivers, not the daily chart. That's your anchor. If you don't take the step, you will also have doubts. The price will rise further. You'll wonder if you missed out. When that happens, remember your alternative why. You bet on stability, innovation, and the traditional system's resilience. That is also a valid anchor. There is no perfect path without doubt. There's only the path you choose and the resolve to walk it. so choose a path. Any deliberate path is better than lingering in the middle, worried and paralyzed. Indecision is the most expensive position of all. It costs you peace of mind and time. Now, we've reached the very end. I'll leave you with a final observation, not about finance. Look at the oldest trees in the world. They survive storms not by resisting every wind, but by having deep, resilient roots. Financial roots are similar. They aren't flashy. They're slow-growing and silent. They exist beneath the surface, providing stability for everything above. Gold can be one of those roots, if you let it. A small, deep, silent part of your financial foundation. Or your roots can be entirely elsewhere. In productive businesses, in land, in your own skills. The composition is personal. The principle is universal. Have deep roots. With that, our conversation is over. You have the information. You understand the landscape. The next move is a quiet one, made by you, for you. Make it calmly. Then go live your life. That's the ultimate sign of a good financial plan. It lets you stop worrying and start living. Thank you for your time and for your thoughtful attention. This is the end of the script. You have all the pieces. The story of gold, the psychology behind it, the risks, and the practical steps. Nothing more needs to be said. The final word is yours. It's the action you take or don't take after you finish listening. That action will be based on your own unique circumstances. No narrator can guide you there, but I can offer one final human truth. The most valuable assets you have are not in any market. They are your time, your attention, and your peace of mind. Invest those wisely. If exploring gold has brought you clarity, then it was time well spent. If it has brought only confusion, then let it go. Your mental energy is precious. Direct it toward things you can control. Your savings rate, your spending habits, your financial education. Those matter far more than any single asset. Gold at its best is just a tool to protect the wealth those habits build. It is not the source of wealth. Never confuse the shield with the sword. The sword is your own effort and ingenuity. The shield is what preserves it. So pick up your sword first. Forge it with hard work and smart choices. Then, and only then, consider if you need a shield and what that shield should be made of. For some, it will be gold. For others, it will be something else. There is no universal answer. There is only your answer. Find it. Trust it. And then, step away from the constant analysis. The world will keep turning. Markets will keep moving. Headlines will keep shouting. You don't have to listen to every shout. You can choose quiet. You can choose to be informed, but not obsessed. Prepared, but not paranoid. That is the balanced middle ground. That is where good financial decisions live. We started with a simple question. Is it too late? We end with a simple answer. It's never too late to think clearly. It's never too late to make a plan. It's never too late to take a small, deliberate step toward security. What that step looks like is yours to decide. This is where your own voice takes over. The narration ends here. The rest is up to you.